Today's dividend investing video, it is really important. I am going to share part of my dividend strategy today that I have not shared before. In fact, I've been building this channel. I'm now over 7,000 subscribers. Thank you for subscribing. I am so grateful for that. And as I've been building this channel, I've been layering in bits and pieces of my personal portfolio and my strategy over time. And in fact, in two of my recent videos, I disclosed how I purchased BP a few years ago. And this is when oil had tanked, the company wasn't doing well. And by taking that risk, I am now yielding over 8% on cost on some of the purchase lots that I purchased in BP back then. That was certainly a rule breaker. It kind of broke some of the rules that I typically follow. Another one that I shared recently is Campbell Soup. And I just purchased some more Campbell Soup. And this is during a time when the company is facing some turmoil. It's breaking some of my rules. I'm going to link in the description below, by the way, to both of those videos, so please check them out. But both of these, I kind of look at these as more of deep value type opportunities as opposed to my normal value type of opportunity. And so I want to discuss the difference today between deep value and value, how both play a role in my portfolio, and quite frankly, how an investor who can assess the difference between the two and can potentially incorporate the two into one strategy, in my opinion, is a really sophisticated investor. It's someone who has kind of mastered the basics and is starting to layer on some more advanced strategies. So let's get started. So welcome to the video, everyone. I am so excited to be here today. I just did this Campbell Soup video, and I did it a few days ago. It's gotten a good response, but what I also noticed about this video is the comments. They're a little bit more polarized than normal. I've got people who are really supportive, but I've got people who are skeptical, and I think it is great. I love that. I love that conversation. And the reason I think so many people are skeptical is I'm talking here about more of a deep value type of buy. And when I make a deep value purchase, it's a lot different than a normal value purchase that I purchase on an ongoing basis in most of the stocks that I've discussed here. And so if you've been following me for a while, you know that there's three buckets of stocks that I typically have in my portfolio. I have small ancillary positions, medium positions, and large core positions. But you might have not known that I also have a subclassification. I look at stocks that are value oriented, and I look at stocks that are deep value oriented. And typically, I will only buy a stock if I believe it's on sale, that I believe it's a value. But there's orders of magnitude of a sale. There's a correction, of 20, 30% in a stock where the fundamentals are intact, everything looks good. I kind of look at Pepsi and 3M this way. These are two stocks that I own. These are value stocks. They've corrected a bit. They've got good starting yields right now. I think that they're on sale. Fundamentals are intact. Is that a deep value? No. Those are the types of stocks. Those are my bread and butter. That's what I usually buy on a month-by-month basis. And that is predominantly the strategy that my entire dividend portfolio operates by. But I have some stocks in my portfolio that fall more into what I like to call a deep value bucket. And some recent examples of these that I've discussed on my channel are Campbell Soup. General Mills is another one. It's very similar, has many parallels to Campbell Soup, and BP. Although BP I don't believe is a deep value now. It was when I bought back in 2015 in that time range. And so the difference between a value stock and deep value is typically with deep value, the stock has tanked. It is tanked more than just a value, just a buying opportunity. And oftentimes it is tanked because there is something fundamentally happening. The fundamentals, more or less, they're okay, but they're not 100%. There's something fundamentally that has changed. If I buy a deep value, I certainly believe that the fundamentals will work themselves out over time, but certainly it will take time. It will take time and persistence and potentially 5, 10, or even more years for things to work out. But obviously the benefit of a deep value is there's huge potential upside in dividend growth and share price appreciation. Although I don't really care about the share price appreciation, I'm more looking for dividends and cash flow because I want to live off of dividends. So anyways, I've talked about value here just at length. I've talked about that in a lot of my recent videos, and I'll link to these. The ones about Pepsi and 3M in particular are examples of values, in my opinion, humble opinion right now. Today's video, I want to start talking about deep value and how it differs a bit. And mind you, Campbell Soup, as an example, is less than 1% of my portfolio. So I do not like to overweight in deep value. I like to keep my deep value buys a little bit smaller to mitigate risk, but they have a place in my portfolio, and they play a role in the portfolio, and that is creating the opportunity for even better returns than I would have otherwise received. So let's talk about Campbell's Soup. Bucket 2 involves risk taking. The fundamentals have potentially changed, and in the case of Campbell's Soup, I want to talk about some of the cons today. I talked about a lot of the pros in the last video, and that was something actually I really appreciate in the comments. People were saying, hey Ian, you forgot about this or you forgot about that. Today I want to get into some of the cons because this is a deep value play. Let's look at the history of Campbell Soup over time. We all know they are known for this. They are known for the soup. Good old Campbell Soup. Now the challenge with this soup is sales have been challenged over time. There have been competitors. There have been competitors that potentially have what some consumers believe to be better products, and this bread and butter of Campbell Soup has been challenged. And so what has Campbell Soup done over time? They have made acquisitions. They've been smart. They've said, hey, I don't want to be tied to this one legacy product if consumers are changing. I want to acquire other companies, and we want to get into new niches. We want to position our company so that it's going to be around for a very long time. And so what Campbell Soup did is they went on a buying spree, and they've done this over the last 5 or so years. And one of the companies that they bought is actually Plum Organics. They make these children's, toddlers food like these blueberry bars, and also pouches like these as well. We love these products in this household. These are great products. And so that is, in essence, what Campbell Soup has been working on over time. But they've approached this in a really unique way. Oftentimes when a company makes an acquisition, they'll use some issuance of stock in conjunction with debt. Well, what Campbell Soup has done is they said, hey, we don't want to dilute the shareholders. We don't want to issue more stock. And so the shares have actually been declining over time, but they've been taking on debt. And so let's look at this. In 2012, they bought Bolthouse Farms. This is an organic foods company. This was a big one, $1.55 billion in cash. What did they do? 2013, they bought Plum. We love Plum. And also this company called Kelsen. In 2015, they bought Garden Fresh Gourmet. Garden Fresh Gourmet was a little smaller. I think that was only in the hundreds of millions range. But then 2018, this just closed. They bought Snyder's and Lance, and this is a big company. Make those Snyder's pretzels, and they also, boy, a lot of synergies, by the way, with their Goldfish and Pepperidge Farm business. But anyways, they bought Snyder's, Lance, all cash, $6.1 billion. So these guys have racked up debt. They have literally racked up debt over time, especially starting in 2012 with the Bolthouse Farms acquisition for $1.55 billion. This is a company, as people have pointed out in the comments below, has a lot of debt. And people have said, like, Ian, yeah, you keep talking about Snyder's, because I've been responding to the comments. I said, hey, debt's up because of Snyder's. But they're like, look, Ian, before that acquisition, they already had a debt problem. Well, the reason they have a debt problem even before that is, well, it wasn't just Snyder's. They bought Bolthouse Farms, Plum, Kelsen, Garden Fresh Gourmet. They've been buying companies for years, and they've been doing it through debt. Personally, I like this strategy. Now, I would much prefer an acquisition in a down market. A lot of these, I think, 2015 and prior were probably at good prices. Snyder's, this market is a bull market. I don't like an upmarket acquisition, especially when they're paying a premium. I bet you they could have gotten Snyder's cheaper if they bought back in 2012. Anyways, that's what they did. At the end of the day, I do think it's a good strategy. I like the diversification. I like them thinking like, hey, Soup, they're going to get Soup back on track, by the way. They're facing, to my understanding, a challenge right now with Walmart. They're having an issue with Walmart that they're trying to resolve. I think their Soup is going to rebound a bit, and they're going to figure that out as well. But that being said, I like the diversification. I think it will pay off over time, my humble opinion. But what has happened? They've racked up some debt. The debt in 2017, by the way, was $3.39 billion. Now, as of 2018, it's at $9.8 billion. Mind you, the market cap of this entire company is around $10 billion now, and that's after the the stock has tanked, but still, this is a lot of debt here. And if you look at ratios like some people like to look at, like the current ratio, it's not looking really good right now. This is the difference between value and deep value. When I buy deep value, usually there's some kind of problem. I go in eyes wide open. This is a big part of the problem right now, is this debt. And they have racked up a lot of it. It could take them 10 years to pay off all this debt. I like that they racked up the debt without issuing new shares, because I don't like shares being diluted, so I'm happy about that. On the other hand, they might have gone a little bit too aggressively on their buying spree. Time will tell. But that is the difference between value and deep value. What else? Well, worth pointing out, shares outstanding. 2018, they have about 301 million shares outstanding. Go back in time, they've just lowered it year by year. 2012, it was 317 million. So at the beginning of all this, Bolthouse Farms, $317 million or 317 million shares. Now it's down, it's lower, it's all the way down at 301. So I'm happy about that. That's a good thing. What else about Campbell's Soup is interesting that someone brought up? Hey, they cut the dividend, and they did this back in 2001. They cut the dividend. This is well before I bought this company, but I did some research. I looked back in time. The reason they cut the dividend back then is because they're facing challenges with the company, with their core product, which was soup. And this seems to be a recurring theme here. There is kind of a built-in change in our society right now. It seems that this core soup product, it is not going to be the company's bread and butter forever. It's not going to be, this company cannot be based on that one mainstay product. And so they started realizing this back in 2001. It's taken the better part of the last 15 plus years, especially in the last 5 or so years, to get away from the soup, to diversify into other brands and different niches. But that is a concern worth noting. They cut the dividend. Could they do it again? Possibly. But when I look at the fundamentals right now, the payout ratio, it's about 49%. And the earnings that are going to come in 2018 projected, more or less, they're the same as 2017. And so if we're going to get earnings similar to 2017, and mind you, 2017 was somewhat of a record year. I don't know if it was the best year ever, but out of all the years I looked at, it was a record year in terms of earnings. And so everyone is panicking, everyone is concerned. But if I take a step back and look at the perspective, yeah, the growth isn't there year over year, but it was a record year in 2017. And yeah, the dividend is well covered with a 49% payout ratio. Now, I don't think the dividend is going to increase very quickly over the coming years, because they're going to use their excess cash to pay down debt. And I would prefer that they do that, quite frankly. But my bet here is looking 10 years out, 15, 20 years out. They've paid all this off. They've diversified really well. Look, we all need to eat. They make great products. These are products that I can stand behind. The cash flow is just going to be tremendous once they pay off that debt, and they will then, at that point, in my opinion, be able to raise the dividend quite aggressively. And that is the game I am playing, that my long-term yield on cost, especially when it comes time for me to retire or semi-retire, start living off of dividends, I will be able to do that, and I will be taking on a little bit of risk here with a deep value, but the hope is that the risk will pay off. But that is a key lesson here, that this is the difference between deep value and value. When I buy Pepsi right now, I don't really feel like I'm taking a lot of risk. I don't really see a lot of issues with that company right now. When I buy Campbell's Soup right now, I still stand behind the fundamentals, but there are more issues. It is a deep value because they've got an overwhelming amount of debt, and they have cut the dividend before, although I'm not really worried about that. It was back in 2001. And it's going to be challenging for them. Their CEO had to step down. That's a whole nother topic. I think that was probably unnecessary, but that's the politics that will be at companies sometime. And so anyways, that can happen. But that's the difference. So let's go on to BP. BP, this one's a little bit easier. By the way, General Mills, it falls into the same category as Campbell's, so I'm not going to go into that in a lot of detail today, or any detail for that matter. But mind you, I look at that somewhat as a deep value right now. It's going to take some time for the recovery, but I'm willing to take on that risk. So with BP, Everything looks good now. I'm yielding 8% on cost, or more than 8% on cost on some of my purchase prices. And everything looks good right now. Oil's back up in that $70+ range. In fact, Brent is at, I think, like 78 or so. And so that's great. But back when I bought, that was not the case. When I bought at $29.57 per share in 2015, oil was at 45. And when we transitioned from 2015 into 2016, oil went from 45 down to a low of $29. BP does not make money at those levels. That is a fundamental shift. Certainly, I predicted at that time that oil would eventually recover. I didn't think it would recover as quickly as it did. But the fact of the matter is, when I bought back then, that was considered a deep value. And that was a risk-taking exercise. It was an exercise in risk. I was taking on risk because what if oil did not recover? What if it was stuck down there? BP would have had to cut the dividend, potentially. BP would have had to take more drastic actions to lay off workforce, to sell off assets. This was after the Deepwater Horizon issue, by the way, and a horrible, horrible, tragic mistake that happened with Deepwater Horizon. That company was already having issues, and then the price of oil is tanking. I was taking on risk. This was calculated risk. Again, this is not my bread and butter stock. Neither of these will ever be a core stock in my portfolio, but deep value has a time and place, and it has a time and place in my portfolio. If my portfolio were a lot smaller, maybe it would not. If I were just getting started out, hypothetically, maybe deep value would not have as much of a place in my portfolio. Maybe I would be more focused just on building those core pillar stocks, the values, buying those great stocks at value prices that I love so much. But now, given the size of my portfolio, from time to time, I like to buy these deep values, and they do have a time and place, and they work for me. BP certainly worked out really well. Time will tell what happens with Campbell's. It'll be really, really interesting to see what happens with that company. Certainly, I think more downside could be ahead. We shall see. So thank you for watching, and thank you for all the comments. It is really the comments that drove this video today. I wanted to add some more insights around my strategy specific to the recent comments. So if you have comments, questions, please put them below in the comments section. I am always looking at those, and I try to respond to all of them. Before I leave today, just a full disclosure, I own the stocks that I mentioned in today's video. So I am long. I own PepsiCo, ticker symbol PEP, 3M Company, ticker symbol MMM, Campbell Soup, ticker symbol CPB, General Mills, ticker symbol GIS, and BP, ticker symbol BP. Also, in terms of a friendly disclaimer, this is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Thank you so much for watching. I will see you in the next dividend investing video.